Hi there, welcome to Nepi Invest. Today I'm going to be talking about EPS. So what is EPS? Why EPS is important, how to calculate it, where to find it, and even some of the limitations behind EPS. So let's get stuck into it and see what EPS means. So EPS simply stands for earnings per share. And probably the simplest way to define earnings per share is it's a simple guide to a company's profitability. So that's the simplest way to put it. I'm going to leave it at that for the moment and just look at how you calculate it here. So earnings per share is simply looking at the earnings or the company's profit and divide that by the amount of shares a company has on issue or the amount of shares a company has. So it's a very simple calculation when you look at it, but it can give you a lot of guide to how much profitability a company has. So the importance of EPS when you break it down. So in itself, EPS has little relevance. If you told me the EPS of a company is 6, there's no context there. It doesn't give me anything. I don't know. It's meaningless. It's pointless. It's nothing. So even if you compare it to another company that has an EPS of 50, again, irrelevant. There's no importance. It's just like a share price. If you told me a share price was $1.50, so what? There's no relevance there. There's no context. You need to know some other numbers. You need to know what the share price was in the past, or you need to know some other factors. But in saying that, EPS is important because the earnings growth of a company or the future earnings growth of a company is what drives the share price moving forward. The only reason why you're going to be invested in a company is you're hoping its revenues or its earnings can grow over time. And if it can grow over time, that would lead to share price appreciation. And share price appreciation is what we want as an investor. So the main thing we're looking for here is trends over time. So we can see the trends going back, and then we can sort of maybe use the trends in the past to just look at the trends moving forward. So where do you find EPS? So you can just look at the finance website. So I've used here Finance Yahoo, looking at one company, A2 Milk. And I've got circled there the EPS. TTM just means trading 12 months, so that's irrelevant here for now anyway. But I'm using this example because, and got here beware, because sometimes these finance websites, their numbers they've got here might be wrong, incorrect. And they've got here 18 cents per share. And how I find EPS is just go straight to the source, straight to the company's report, and they've got it here. They've got it here for you. This is A2 Milk's annual report on page 60, the income statement. They've got EPS. They calculate it for you. You don't have to do any calculations. So on the left-hand side, I've got circled in red, and then I've got it zoomed in on the right-hand side. So just above 52 cents per share. Don't worry about the difference between basic and diluted. Diluted just takes into account convertible securities. So convertible securities are just those securities that might be converted to shares in the future. It's irrelevant here. There's not much difference between the two. But you can see here, A2 Milk's earnings per share is 52 cents per dollar, which is 52 cents per share, which is a little bit different from Yahoo Finance, which was 14 cents per share. So big difference there. So go straight to the source. I've also got circled here earnings or profit for the year was $385.8 million. So that's the earnings or profit used in the calculations. So if you're inclined to really break it down to understand where it comes from, it's always good to understand how they calculate the earnings per share. So I've got earnings here, 385.8. Shares on issue you can find that straight from the annual report too, is 736.4 million. just divide earnings by shares on issue and 52.4 cents. Very simple. That's how simple it is. So nothing complex whatsoever, but usually when I look at earnings per share, I go straight to the source and I don't do any calculation whatsoever. Now, I've mentioned before, trends are very important. So what I'm looking for is an uptrend. You can graph it and just looking for a good uptrend slope. And this is CSL, arguably Australia's best company on the ASX. And it's priced like that too, with a PE of around 40 or just above 40. So over the last 14 years or so, we can see a very solid uptrend in the earnings per share from 21 cents in 2006 all the way up to $6.75. So that's a very good uptrend. That's 55 times, that's almost 35 times increase over those 14 years. There is a little bit of a caveat there. I'll get to that into a second. There's some other numbers here you can look at, but everything's pointing upwards, except shares on issue, which is going downwards, but they're doing share buybacks. They were doing it anyway. Now, some limitations around earnings per share. It should not be used in isolation. I've already mentioned this before, so don't look at earnings per share for 1 year for one company and think you can take anything from that. You need to look at it in context, look at the growth, look at the trend, that sort of thing. Earnings can be influenced by one-offs, and I'll get to 2006 in CSL in a moment. So one-offs could be write-downs, that sort of thing. It can also be manipulated by companies through buybacks. So you can, if you think of how you calculate earnings per share, the denominator is shares on issue. If you decrease the denominator by doing buybacks, so buybacks is just buying shares back, decreasing the amount of shares on issue. If you decrease our denominator, the earnings per share will go up if earnings stays the same. I'll get to an example on that in a second. And stock splits, that's the complete opposite to buybacks. If you do a stock split, for example, Apple and Tesla did it recently, that means the denominator actually goes up a fair bit. Earnings per share will go down a fair bit. So if you increase the denominator, you decrease the earnings per share. So if they're doing, a company is doing a stock split, that earnings per share should have this one almost instantaneous jolt down from a high number to a very low number. So here's an example of a buyback. This is a theoretical example. This did not happen in real life. So just to imagine A2 Milk, they had an earnings per share of 52.4 cents in the past year based off shares on issue of 736 million. So just imagine the next year management was thinking there's not going to be any increase in earnings whatsoever. It's going to remain static. But we need to increase our earnings per share to get some remuneration rewards. So they could have incentives built into their remuneration, and one of those incentives could be they need earnings per share to go up 10% to get maybe $2 million or so. This is not a real life. A2 Milk does not do this. But just imagine if they did, and they knew earnings were not going to increase. So how they get earnings per share to increase? Well, do a buyback. So they're going to buy back 230 million shares. It's simple. They've got enough cash on hand, maybe, that sort of thing. So this is really bad capital allocation on management's behalf, but they might do this to get, very selfish reasons, to get extra money from the company. So in this example, shares on issue goes down from 736 to 506 million. And so that denominator decreases, earnings remains the same, no increase in earnings. So they've increased earnings per share from 52 to 76. They get their reward. They get their, incentivized rewards for increased earnings per share. Not all companies do this, but some companies do. So be aware of this manipulation of earnings per share through buybacks. It does happen. Now, the important thing is to look for trends. I've already mentioned this, and I've got here an example of EPS trend for CSL from 2004 to 2009. You see a very good uptrend, but 2006, there was this little blip in the EPS numbers here. It just stands out from the crowd quite substantially. If you actually did graph this, there's this little bip and then goes back up to the normal rate of increase. So what happened in 2006 is CSL bought out a company. They acquired a company called Behring, I think it was, that fit very well with what they did. But because of that, that acquisition, some of the accounting things they did meant that the earnings that year for the company was down, a one-off down, but that means the earnings per share went down. And then it went back up the next year. So you have to be aware of this sort of thing. I think we saw no substantial decrease in share price. So the market was aware of this one-off, but you need to be aware of this too, and don't react to this one-off at all. So that's all for today's video. Hope you enjoyed it. If you have any questions, leave it in the comment. Make sure you subscribe too. And I'm not a professional advisor, so don't take any advice I give you as professional advice. I'm just doing this for educational and informational and entertainment purposes. So that's all for today. Hope you've enjoyed this video, and hope you join me again for another video I'll do in the future. More than likely, the next video I'll do would be PE ratio, educational video anyway. So that's all for today. Have a good day.